Welcome back to the channel. If you're just tuning in, take a second and lock in, because what we're seeing in the markets right now is not random volatility, and it's definitely not retail panic. This move was telegraphed, it was timed, and it was executed exactly the way large players operate when liquidity events are approaching. We warned that markets were vulnerable heading into this week, originally expecting the pressure closer to the Bank of Japan interest rate decision. Instead, the dump came early, Monday morning, and it came fast. That alone should tell you this wasn't emotional selling, it was positioning. Here's what most people miss. Markets don't wait for headlines to react, they move ahead of them. By the time the majority is watching the decision, the damage is often already done. That's exactly what played out here. Market makers and large players knew what was coming, knew how liquidity would react, and acted before the crowd had time to adjust. Orders that were placed in advance started getting filled immediately, which is how you know this wasn't reactive. It was planned. Now let's address the argument people always throw out in moments like this. It was already priced in. That phrase gets abused constantly, and most of the time it's used incorrectly. Something being discussed doesn't mean it's fully priced in. Pricing happens when positioning changes, not when opinions form. And what we saw today was positioning finally adjusting in size. That's the difference. The market didn't shrug this off. It repriced risk aggressively. There's also a historical context here that matters. The last several times Japan has raised rates, Bitcoin dropped more than 20% shortly after. That pattern isn't superstition, it's liquidity mechanics. Japan sits at the center of one of the most important funding channels in global markets. When that channel tightens, risk assets feel it. Crypto feels it first. Ignoring that history doesn't make it go away. What makes this move especially important is the way it unfolded. Within minutes, billions of dollars worth of Bitcoin was sold across major exchanges. That doesn't happen by accident. Retail doesn't move markets like that. Coordinated selling of that size requires deep liquidity access, algorithmic execution, and pre-positioned intent. This was a market maker-driven event, not fear from people waking up and smashing sell buttons. And this ties into a much bigger issue crypto has been dealing with since late last year. Several large market makers were hit hard during previous liquidation events and have been forced into long-term unwinds. When big players get caught on the wrong side of leverage, they don't exit all at once. They can't. Doing so would destroy their own books. Instead, they unwind slowly, applying consistent sell pressure over weeks and months. That creates a heavy market where rallies fail and downside feels relentless. This is why price action since October has felt different. It's not just sentiment, it's forced selling meeting thinning liquidity. And when you combine that with a macro event like a Bank of Japan rate shift, you get sharp, ugly moves that feel unfair if you're not prepared for them. But here's the part most people struggle with emotionally. These moves feel bad, but they are not inherently bearish long-term. They are cleansing events. They expose weak positioning, excessive leverage, and speculative excess that built up during easier conditions. Markets cannot move higher sustainably without flushing that out first. Every major bull market you've ever seen was preceded by a phase that felt exactly like this. The problem is that most participants experience these phases through emotion instead of structure. They see red candles and assume the entire thesis is broken. They forget that price is not a reflection of value in the short term. It's a reflection of liquidity and positioning. And when liquidity is being pulled, price doesn't care about narratives. This is also where patience separates outcomes. Large players don't panic during these events. They prepare for them. They set orders in advance. They wait for liquidity to come to them. They understand that coordinated dumps create opportunity precisely because they scare out weaker hands. None of this means the pain is over instantly. Liquidity events don't resolve in a single day. They play out over time. But understanding why the move happened is the first step toward navigating it correctly. If you don't understand the mechanism, you end up reacting emotionally. If you do understand it, you can think in probabilities instead of panic. To really understand why this move happened the way it did, you have to step outside the crypto bubble and look at the funding layer underneath global markets. This isn't about sentiment, narratives, or who tweeted what. This is about where capital actually comes from and how changes in interest rates ripple through every risk asset. And one country, more than most people realize, sits right at the center of that process: Japan. For decades, Japan has operated with ultra-low interest rates. While the rest of the world moved up and down through tightening and easing cycles, Japan stayed near zero. That created one of the most powerful liquidity engines in modern financial history. Global institutions could borrow yen at extremely low cost, convert it into other currencies, and deploy that capital into higher-yielding assets elsewhere. Stocks, bonds, real estate, and eventually crypto all benefited from that flow. This wasn't some niche hedge fund trick. This became a structural feature of the system. Trillions of dollars were deployed globally through this mechanism over time. As long as Japanese rates stayed pinned near zero and other markets offered higher returns, the trade worked. Liquidity flowed outward. Risk appetite expanded. Leverage grew quietly in the background. Here's the key point most retail investors miss. When money is that cheap, it doesn't just boost safe investments. It pushes capital further and further out on the risk curve. Investors take more risk not because they're reckless, but because the funding environment rewards it. That's how valuations stretch. That's how speculative excess builds. And that's how crypto becomes one of the biggest beneficiaries during expansion phases. But that entire structure depends on one condition holding steady. Japan must remain the cheapest place in the world to borrow. Once that condition starts to change, the math breaks. And that's exactly what's happening now. Japan has begun raising rates to defend its currency and regain control over inflation pressures. At the same time, other major central banks are either pausing or preparing to ease. That shift compresses the interest rate differential that made the carry trade so attractive in the first place. When the spread narrows, borrowing becomes more expensive and returns become less compelling. At that point, institutions don't have a choice. Positions that were funded with cheap yen have to be reduced, not because managers suddenly turn bearish, but because risk models and balance sheets force adjustments. Liquidity that once flowed freely starts getting pulled back. And this is where people misunderstand how markets actually move. Liquidity doesn't vanish in a dramatic flash. It unwinds, slowly at first, then more aggressively as feedback loops kick in. Large players don't dump everything in one shot. They unwind positions methodically to avoid destroying their own books. But even controlled selling has consequences. It suppresses upside. It increases volatility. It creates the kind of price action that feels heavy and frustrating. Crypto reacts faster than most markets because it's thinner and more leveraged. When capital needs to be raised quickly, crypto is one of the easiest places to do it. It trades around the clock. It has deep global access, and it responds immediately to changes in liquidity conditions. That's why crypto often looks like it's overreacting when in reality, it's simply reflecting the shift before other markets fully process it. This is also why arguments like "this was already priced in" tend to fail in real time. Pricing in isn't about awareness. It's about positioning. Markets can talk about an event for weeks and still move violently when capital actually starts adjusting. What we saw was not a reaction to news. It was a reaction to funding conditions changing beneath the surface. Another important detail is timing. Liquidity shifts don't respect clean calendars. They don't wait politely for announcements. Institutions front-run these events because they have to. By the time an official decision is delivered, the repositioning is often already underway. That's why moves like this tend to catch people off guard, even when the event itself was widely known. And this brings us back to the broader picture. What we're seeing now is not isolated to one asset, one exchange, or one narrative. It's a global funding adjustment working its way through the system. Crypto just happens to be the most sensitive pressure gauge. Understanding that doesn't make the volatility disappear, but it gives it context. This isn't chaos, it's mechanics. It's the system responding to changing incentives. And once you see it through that lens, the price action stops feeling random and starts feeling inevitable. Now, this is where the reality of crypto market structure really shows itself. Because when liquidity tightens, crypto doesn't just follow traditional markets. It magnifies whatever stress is already there. This space is thinner, faster, and far more leverage sensitive than stocks or bonds. That's why moves tied to global funding shifts tend to look extreme here, even when the underlying cause is mechanical rather than emotional. When institutions are forced to reduce exposure, they don't sit around debating narratives. They sell what's liquid, what trades 24/7, and what can raise cash immediately. Crypto fits that description perfectly. It's not that these players suddenly lose conviction in digital assets. It's that crypto becomes a funding source. Capital has to come from somewhere, and during liquidity events, crypto is one of the first places it's pulled from. This is why fundamentals don't protect price in the short term. You can have strong development, partnerships, adoption progress, and regulatory momentum, and still see price get hit hard. Liquidity-driven sell-offs don't discriminate. They don't care about roadmaps or long-term visions. They care about balance sheets, leverage ratios, and margin requirements. If something needs to be sold, it gets sold. That's also why correlation spikes during these phases. Assets that normally behave differently suddenly move together. Bitcoin drops, altcoins drop harder, and even projects with very different use cases trade as if they're the same thing. In stress environments, diversification inside crypto often disappears. Everything becomes a risk asset, and risk gets reduced across the board. XRP sits squarely inside that dynamic. It may not be the most heavily leveraged asset in the market, but it is deeply correlated with broader crypto and equity risk when liquidity tightens. When large players de-risk, XRP gets pulled into that flow. That doesn't mean XRP is broken. It means XRP is trading inside a system that is actively deleveraging. This is where a lot of people get mentally trapped. They look at falling price and assume something must be wrong with the asset itself. In reality, what's often happening is forced selling that has nothing to do with XRP's fundamentals. Liquidity events create overshoots. They push price below levels that feel unjustified, and they do it precisely because selling is not voluntary. It's mechanical. From a technical standpoint, this is why support levels often fail during liquidity-driven moves. Support works best when markets are balanced. It works when buyers and sellers are acting freely. During forced selling, that balance disappears. Stops get hit. Liquidity gaps form. Bounces become shallow and short-lived. This is also why relying on "I'll just sell if it breaks support" is dangerous in environments like this. When everyone tries to react at the same time, execution quality collapses. Another factor people underestimate is duration. Liquidity unwinds rarely resolve in a single violent move. More often, they play out as a grind. Pressure builds, releases slightly, then builds again. Rallies fail. Optimism gets punished. Patience wears thin. That's not an accident. That's how markets transfer assets from emotional participants to disciplined ones. This grind is especially hard for newer participants. People who entered during expansion phases are used to quick recoveries and constant dips getting bought. Liquidity contractions break that expectation. Good news stops working. Bad news hits harder than it should, and confidence erodes slowly rather than collapsing all at once. For XRP holders, the key here is separating timeframes. Short-term price action during a liquidity unwind is not a verdict on long-term relevance. It's a reflection of positioning and capital flow. If you confuse the two, you end up making long-term decisions based on short-term stress. That's how people sell near lows and buy back later at higher prices when conditions feel safe again. This is also where probability thinking matters more than prediction. You don't need to know the exact bottom. You need to understand that during liquidity stress, downside risk expands before opportunity appears. Markets almost never reward early optimism. They reward patience after leverage has been flushed and forced selling exhausts itself. So the mistake to avoid in this phase is denial on one side and panic on the other. Pretending crypto is immune to macro forces is dangerous, but assuming every drawdown means failure is just as wrong. Liquidity-driven sell-offs are part of how markets reset themselves. Once you understand that, you stop reacting to every candle and start thinking in phases instead. Deleveraging comes first. Stabilization follows. Reaccumulation happens quietly. And only after that does expansion return. Every major cycle follows that rhythm, even if it feels chaotic while you're living through it. Now let's zoom out, because if you stay locked into day-to-day volatility, you miss what this phase is actually doing. Markets don't punish everyone equally during liquidity contractions. They punish excess, and that's intentional. This is the part of the cycle where weak structures get exposed and stronger ones quietly separate themselves from the noise. Every major market cycle follows a similar path. Easy money creates expansion. Expansion encourages speculation. Speculation breeds leverage, and leverage eventually creates fragility. When liquidity tightens, that fragility gets stress tested. Projects, strategies, and participants that relied on constant inflows start breaking down. What survives is what can function when liquidity is no longer doing all the work. This is why these periods feel unfair. Assets that looked unstoppable suddenly underperform. Narratives that felt obvious stop working. People who were loud during the upside go quiet. But beneath the surface, something important is happening. Capital is being forced to choose. It can no longer chase everything. It has to become selective. For crypto, this is where maturity starts showing. Earlier cycles were almost entirely retail-driven and narrative-driven. This cycle is different. Institutions, custodians, regulators, and infrastructure providers are now deeply involved. That changes how capital behaves. Institutional capital does not chase hype during stress. It waits, it studies, it reallocates toward clarity, compliance, and survivability. This matters for XRP because XRP sits closer to infrastructure than speculation. That doesn't protect it from drawdowns. Nothing does during liquidity contractions, but it does influence how it's treated once markets begin stabilizing. Assets tied to settlement, payments, and regulated financial rails tend to re-enter favor earlier than assets that exist purely for speculative trading. Another mistake people make is assuming that opportunity only appears when price starts moving up again. That's rarely how it works. Opportunity usually appears when price stops going down despite negative sentiment. When forced selling dries up, volatility compresses, and the market goes quiet. That's often the real turning point. But most people aren't paying attention then. They're waiting for confirmation that comes later. Time is the hardest part of this phase. Liquidity resets don't resolve in weeks. They take months. And that time element is what breaks most participants. People get bored, they get frustrated, they disengage, they convince themselves the opportunity is gone. And that's usually when long-term positioning quietly gets built by those who understand the cycle. This is also why long-term positioning isn't about blind conviction, it's about alignment. Understanding which assets still matter when the market isn't rewarding speculation. Understanding which narratives persist when attention disappears. And understanding that survival through the uncomfortable part of the cycle is what gives you exposure to the next expansion. If this unwind continues the way similar episodes have in the past, the market eventually reaches a point where selling pressure exhausts itself. Price stabilizes even though headlines remain negative. Confidence is still low, and that's exactly when conditions quietly start changing. Not dramatically, not explosively, but structurally. So the question to ask yourself in this phase isn't how fast can this recover, it's what still matters when liquidity is tight. Because whatever still matters then is what usually leads when liquidity returns. Now let's bring everything together, because if you strip away the noise, the emotions, and the daily price swings, what's happening right now becomes much clearer. This is not a random market crash. It's not a failure of crypto. And it's not some mysterious force targeting retail investors. What we're witnessing is a liquidity-driven reset, one that was set in motion long before this week and is now working its way through the system exactly the way these cycles always do. Coordinated selling, forced unwinds, and heavy downside pressure don't happen because markets suddenly decide to be bearish. They happen because leverage has to be reduced and capital has to be repositioned. When funding conditions change, risk gets repriced, and crypto, being one of the most liquidity-sensitive markets, absorbs that impact first. That's uncomfortable, but it's also normal within the context of how global markets function. For XRP holders, this is where perspective matters most. Short-term price weakness driven by macro liquidity does not invalidate long-term utility, infrastructure progress, or broader adoption trends. It simply means XRP is trading inside a system that is actively deleveraging. Confusing that mechanical process with a failure of the asset itself is how people make decisions they later regret. This phase rewards preparation, not prediction. You don't need to call the exact bottom. You don't need to perfectly time every move. What matters is understanding that during liquidity contractions, volatility expands, patience gets tested, and markets overshoot in both directions. That's how excess gets flushed and how stronger structures eventually emerge. It's also important to understand that these periods are when narratives flip. During expansion, everything looks bullish and obvious. During contraction, everything looks broken and hopeless. The truth usually sits somewhere in between. Markets don't move based on emotion, they move based on incentives. And right now, incentives are forcing capital to be cautious, selective, and defensive. As this phase continues to play out, the people who struggle the most will be those reacting emotionally to every candle, every headline, and every opinion. The people who come out stronger will be the ones who stay disciplined, respect macro forces, and think in phases instead of moments. Deleveraging comes first. Stabilization follows. Reaccumulation happens quietly. Expansion comes later, when almost no one expects it. None of this means ignoring risk or pretending everything is fine. It means acknowledging reality without panic. It means understanding that volatility is a feature of these transitions, not a sign that the system is collapsing. And it means positioning yourself so that no single move, no single week, and no single event forces you into decisions you didn't plan for. Before we close, it's critical to be absolutely clear. Everything discussed in this video is for educational and informational purposes only. This is not financial advice. I am not telling you what to buy, sell, or hold. Markets involve risk, and you are responsible for your own decisions. Always do your own research, understand your financial situation, and never invest money you cannot afford to lose. If you can keep your head during periods like this, you give yourself an edge most people never develop. Not because you're smarter, but because you're disciplined. And in markets, discipline is what survives every cycle.